We first need to understand why classical computing has always fallen short when faced with the staggering complexity of global finance. Analyzing every market movement, every trading pattern, every economic signal, all in the time it takes a traditional computer to blink. This is not science fiction. This is quantum computing, and it is quietly beginning to reshape the way the world thinks about money, markets, and the future of financial prediction. The question burning through Wall Street boardrooms and Silicon Valley labs alike is deceptively simple. Can quantum computing actually help us predict where markets are going? Can it give traders an edge so sharp it changes the game entirely? And what does it mean for the explosive, chaotic world of cryptocurrency? This is precisely where quantum computing enters with a fundamentally different promise. Every piece of information is either a 0 or a 1. A bit is either off or on. This works brilliantly for most tasks, but financial markets are not most tasks. Markets are living, breathing ecosystems of human behavior, geopolitical tension, corporate earnings, interest rate decisions, social media sentiment, and thousands of other variables all colliding in real time. When a classical computer tries to model all of these interactions simultaneously, it hits a wall. It must process possibilities sequentially or in limited parallel threads, which means the deeper and more complex the analysis, the longer it takes and the more computational resources it burns. High-frequency trading firms have spent billions building faster hardware and fiber optic cables to shave milliseconds off their execution times. But even the fastest classical systems are fundamentally limited by their binary architecture. Portfolio optimization, risk modeling, options pricing, and fraud detection all demand a level of simultaneous multivariable analysis that classical computers struggle to deliver at the scale modern finance requires. And to risk analysis, where thousands of correlated variables must be weighed against each other in real time. Unlike classical bits, qubits can exist in a state of superposition, meaning they can be both 0 and 1 at the same time until they are measured. This allows a quantum computer to explore an enormous number of possibilities simultaneously rather than one at a time. Add to this the principle of entanglement, where qubits become linked so that the state of one instantly influences the state of another, regardless of distance, and you have a system capable of processing interconnected variables in ways that are simply impossible for classical machines. For finance, this is transformative. Consider portfolio optimization, the process of selecting the best combination of assets to maximize returns while minimizing risk. A classical computer analyzing a portfolio of 500 assets must evaluate an astronomically large number of possible combinations. A sufficiently advanced quantum computer could theoretically evaluate all of those combinations simultaneously, identifying the optimal portfolio in a fraction of the time. In the world of trading, speed and accuracy are everything. Quantum algorithms are being developed that could identify arbitrage opportunities, detect market inefficiencies, and execute trades with a precision that classical systems cannot match. Firms like Goldman Sachs, JP Chase, and IBM have already begun investing heavily in quantum research specifically aimed at financial applications. JP Chase has published research demonstrating how quantum algorithms could accelerate Monte Carlo simulations, which are used extensively in options pricing and risk assessment, by a factor of 100 or more compared to classical methods. This is not a distant theoretical possibility, it is active research with measurable results. Quantum machine learning is another frontier where the implications for trading are profound. By training quantum models on vast historical datasets, it becomes possible to detect subtle, nonlinear patterns in market behavior that classical machine learning models would miss entirely. These patterns could form the basis of trading strategies with significantly higher predictive accuracy, giving quantum-equipped firms a decisive and potentially insurmountable advantage over those still relying on classical infrastructure. Cryptocurrency markets are notoriously volatile, driven by a chaotic mix of speculative sentiment, regulatory news, technological developments, and macroeconomic forces. Predicting price movements in assets like Bitcoin or Ethereum has humbled even the most sophisticated classical algorithms. Quantum computing introduces a new dimension to this challenge. Because quantum systems can process and correlate vastly more variables simultaneously, they hold the potential to model cryptocurrency market dynamics with far greater nuance. Sentiment analysis drawn from social media, on-chain transaction data, whale wallet movements, regulatory signals, and cross-market correlations could all be integrated into a single quantum model that updates and recalibrates in near real time. Beyond prediction, quantum computing also intersects with cryptocurrency at a deeper, more existential level. The cryptographic security underpinning most blockchain networks relies on the computational difficulty of solving certain mathematical problems. A sufficiently powerful quantum computer could theoretically break these encryption standards, which has prompted the entire blockchain industry to begin developing quantum-resistant cryptographic protocols. This arms race between quantum capability and cryptographic defense is already underway, and its outcome will shape the long-term security and viability of decentralized finance. It would be dishonest to paint quantum computing as a fully realized financial superpower available today. Current quantum computers are still in what researchers call the noisy intermediate scale quantum era, meaning they are powerful but error-prone and limited in the number of stable qubits they can maintain. The kind of fault-tolerant, large-scale quantum systems needed to truly revolutionize financial modeling are likely still a decade or more away from widespread commercial deployment. However, the trajectory is unmistakable. Investment in quantum computing reached over $30 billion globally in recent years, with financial services representing one of the largest application sectors. Hybrid approaches combining classical and quantum processors are already delivering incremental advantages in specific financial tasks. For investors and traders paying attention, the message is clear. Quantum computing will not replace human judgment or eliminate market uncertainty overnight, but it will dramatically shift the competitive landscape of finance, rewarding those who understand and adopt it early. The firms and individuals who begin building quantum literacy now, who follow the research, who understand how these systems will integrate with trading platforms and investment strategies, will be positioned at the front of a transformation that promises to be as significant as the arrival of the internet in financial markets. The machines are getting smarter, the markets are getting more complex, and the edge of tomorrow is being built in quantum laboratories today.